Welcome, folks, to BTFD. We have the inimitable CheesNWine joining us. CheesNWine on the markets. Chess, what do you got for us? An interesting day thus far.
How you doing, Bob? Great to be here with you, as always. It looks like the S&P here, we're off the highs, obviously, from the session this morning. Came out with some decent strength, and they faded it. And I think, again, we've seen such a ferocious and kind of violent V-shaped rally here since mid-October. It's really been the hallmark of this bull market, the QE market, if you will, especially since, let's say, the beginning of 2013. What's interesting is I recall back to the end of 2012, and I remember that particular weekend. Sentiment was so. It's funny because sentiment seems like on Twitter, just from anecdotally, it's been quite bullish for quite some time. The AAII sentiment survey backs that up too. In general, I think bullish all-time highs, I believe, this morning. And basically, sentiment back then, at the end of 2012, was just so negative. Bull market, the QE market, if you will. There were definitely some divergences of the bullish variety back then, the 2012. The Russell 2000, I remember, was diverging bullishly, and I was positioned very long, a couple of leverage long ETFs. I was leverage short volatility. I want to say into New Year's, crossing over in 2013, and I remember there was that one weekend where the futures were down at one point 300 points, and then I remember thinking to myself, oh, well, I guess I'm going to have to take my lumps come Monday or after New Year's and just kind of, take some losses. And then I remember by the time, the bell rang on Monday morning or something to that effect after New Year's, futures were up 300 points. And we never looked back. And I think that was a seminal moment. And obviously, everyone who was bearish and pressing down there felt kind of the pain, and we never even came close. I think it was the epitome of the bullish breakaway. My point is we've come a long way since then, not just in terms of price, in terms of sentiment, in terms of how many new traders have come to the market, and they only know of kind of one way in which to trade. The idea that you always have to buy the breakdown, so to speak, that every single bit of selling amounts to another buying opportunity. The idea that every single apparent breakdown amounts to a great opportunity to get aggressively long to play for the inevitable V-shaped rally, and that can persist, and it has persisted for a good long while. And it's not constructive at all to argue with that. It's not constructive at all to complain about that. It simply can happen. It's like if you play poker and you're dealt pocket aces and you lose four big pots in a row. Not only can that happen, but it does happen. Okay, and you just have to take it for what it's worth. And I think the idea is to understand that there's no one particular trading style, no matter what bill of goods you're being sold. There's no one particular trading style that's going to be effective in every single kind of market. And the idea is to recognize which markets you're most effective in and which markets you're not particularly effective in. And I think in these kinds of markets, I'm at my best when I'm opportunistic. I take quick shots here and there, and I'm not pushing it overly aggressive. And I think, again, there are many different styles which can work in the market. This particular market, the V-shaped rally market, the QE market, if you will, even though they just tapered it off, still, in these kind of V-shaped rallies, I think there's a certain degree of comfort you have to have with your bankroll, with understanding the idea that you don't always need to be playing every single hand that you're dealt. And again, that's frankly a catastrophic mistake over the long run. So that's pretty much where I'm at here. I'm opportunistic. I'm looking at these intermarket trades. I'm looking at both sides of the tape. I'm looking for a little bit of everything. But at the same time, I'm not looking to take on everything, if that makes sense. So I'm looking to take shots here and there, but I don't need to kind of fire off all the rounds, so to speak, just because the market happens to be open and the casino's open, so to speak. Now, you want to get into some charts here?
Absolutely, love to.
Sure. Let me just try to get this right. Can you see this chart, Bob?
Not yet.
Let me see.
But this V-shaped rally has been just painful to bears. Up now, I see the chart.
Okay. All right. Well, this S&P 500 index daily chart again. down here, I remember I was playing some of the long plays in the Ebola plays, and they were actually trading. I had this working thesis that the long Ebola plays, namely the hazmat makers APT and Lake, and TKMR Techmir was the first one I played. I had this working thesis they could trade inversely to the rest of equities, given the unique situation that Ebola and equities were in at those junctures. Technically, with equities as a whole, and then specifically, those were special situations, and that worked reasonably well. Just taking some shots on the short side. This part, after this V shape, I was initially standing aside. Then I took some shots on the short side. But obviously, this has just been an incredible runaway V shape. And again, I've been showing this on the videos. You take a look at the magnitude of this V shape, Bob, even compared to prior V shapes. And it's just, look, it's something to behold. So if you're in there and you feel like you need to be trading every single tick, so be it. That's not my style. It's not for me. I'm not very good at it. I do what I do. And what I do well at is being opportunistic and waiting for my kind of market. I mean, I was very bullish at the end of 2010, rode that uptrend up. Very bullish at the beginning of 2012, the beginning of 2013, and at those times I could be as aggressive as anyone. But in these kinds of markets, again, I try to stick to what I do best rather than kind of trying to change myself for anyone or anything. And again, today's is setting up to be an interesting day. We've been here so many times where you get what looks like what could be a meaningful reversal, and then maybe they just gap us up tomorrow. But I will say, outlier markets, like I think we've been in this one for a while. The S&P 500 index, I believe, still has not had a 10% correction off the high since 2012. Outlier markets, they can exist, but they don't last. And when this particular market comes apart and starts to change character, I think you're going to see the kind of sea change that we saw, going back to what I said at the top of the video, to tie things up. We're going to see the kind of sea change we saw at the beginning of 2013, the end of 2012, with all these, when we had so many vocal, aggressive bears laying out the big bear case, that the S&P was going back to 900, 1,000. I think the S&P was at 12 or 1,300 back then. And so I think, again, that's the risk here, and I always look at things in terms of risk to reward, not in terms of making bold guarantees and trying to catch every single little tick. I also think the small caps and Russell 2000 index, Bob, lagging a little bit today. They're just kind of grinding higher into oblivion here. You can see in the daily chart. They're still setting up for I said this on the video last night. They're setting up for an interesting weekly close. I felt like if they closed above 1180, 1183, that would negate kind of this idea that the small caps and Russell 2000 index have been topping over the past year or so. That, you can see with today's weakness now, we have a very critical Friday setting up in the Russell 2000 index to see if we close above it or if there's actually downside follow-through to today's weakness today. It's not a bloodbath, but there is some weakness there today. And again, it's just been an awesome, breathtaking V-shaped rally to the high. So beyond that, let me just, one more point before I get back to you, Bob. Leaders have been, this has been my issue too. The leaders ought to be leading. And even if they're not leading at some parts of the bull, that's fine. You can get rotation. You still don't want to see name. And Facebook, remember, Facebook was as strong as any leader. Marquee issues with strong institutional sponsorship, usually housed the NASDAQ Composite Index. Facebook was as strong as any of them. It a little bit of a gap down after earnings. And now it looks like it could still be kind of a short setup. It's leaning down against the 100-day moving average. The whitish-grayish line here. Tesla, it's had a little bit of bounce back, but it's still making a series of lower highs. Netflix looks like a short setup if it loses 378, 377. Either way, it's not a particularly healthy, enticing chart. Price line is short. I got stopped out on earlier this week to keep, again, if I'm going to take shorts in this market, I'm going to keep a lid on these and keep pretty tight stops until I see that real sea change and just take my shots, but still not a particularly healthy chart, Google. So that's where I come out. Obviously, Apple is a special case in my view, very extended away from the 200-day moving average. Not really a growth leader at this point, but fund managers kind of hiding out there. So the overall lack, Amazon, the overall lack of healthy charts among the leaders, the marquee stocks, that has also seen me in the more kind of when in doubt, waited out camp, and just take some shots here and there. And overall, again, this isn't my kind of wheelhouse where I'm trying to really push, the edge here. So that's where I come out here, Bob. I guess I'll send it back to you for a little bit.
Excellent. Well, I had a couple of questions that I wanted to ask you. Items that you've kind of looked at recently, either in your overnight videos or your late night videos that you talked about. And one was that you saw a significant amount of weakness in the banking industry. And I think in particular, I think you pointed to Wells Fargo, WFC. And I think you were hanging around thinking that that potentially for equity players, the triple weighted short or FAS.
Yeah, I'm still long. I'm still long FAS, F-A-Z. You can see I went long a couple days ago, and I think the trade has a chance to work. Yes, on the one hand, this XLF, it could be kind of just a benign bull flag consolidation, but again, just the sheer velocity and the magnitude of this V-shaped rally in the XLF, here's where you're usually going to see these kinds of V-shaped moves. You can see this, right, Bob?
Absolutely.
You're usually going to see these violent V-shaped rallies. Again, it's all a line drawing question, the degree, the magnitude. Look how violent this is. From well below the 200-day simple moving average, the yellow line here, to basically making new 5, 6, 7-year highs or whatever it is. You're usually only going to see that in two situations. The first one would be off of a major bear market bottom, like March 2009. We obviously have not been in an established bear market, so doesn't fit the bill with that element. The second scenario is when we're coming off a very deep broad market correction, like summer of 2011. And then we finally, I think, put in the good price low in October 2011. So you usually see these violent V-shaped rallies off of those kinds of conditions, off of bottoms, and that typically is when it's most bullish because nobody really believes in it. You keep going up, up, and away, and then it simply sets up the next leg higher, and it's called a lockout rally because it locks out the most players from getting in. And obviously, shorts are in a very tough spot. In this particular situation, the XLF has already, and we're seeing this a lot with many charts, it's already been in an established bull market for many, many years. Now, the counter to that argument is that we're in the most hated bull market in the history of the world. Now, again, you look at the sentiment surveys and some of the equity allocations, I'm not so sure that's true, but again, that seems to be kind of that we're in this hated bull market, and that's what, yeah, I mean, that's pretty much what's going on, Bob, as far as that's concerned.
The other question I had for you related kind of to a little bit the coffee trade, and I know that on your week some months ago that you really kind of rode that whole Joe, which is an ETF, coffee, but also I think you saw Starbucks as a potential short maybe a couple weeks ago, but it's been interesting watching that thing, which has been on a slow grind up, and even on a day like today, kind of off really very marginally at this point. Any thought?
You can see my chart now, Bob?
I can.
Okay, yeah. I mean, the thing with Starbucks is if there's no trigger, there's no trade, for me. And when I look at setups, again, I'm not, I don't look at the market in terms of, like, declaring that this is definitely going to happen. Like, I don't think you're necessarily rewarded for there's no such thing as guaranteed points. The market doesn't award you guaranteed points. If you make, all these professional athletes like to make guarantees nowadays, and I look at the market in terms of, potential setups here and there. If they trigger, I'll consider taking the setup. If they don't, then so be it, And I think with Starbucks, you have a situation where this is definitely a big consumer winner over many years, since 2009. And it became very steep. I shorted it back in the spring. Had a nice short trade on it back last April, I believe, during that initial drawdown. And many stocks suffered back then. But you can see it kind of, on this monthly chart, the downside action just kind of abated, the downside pressure. So Starbucks has been drifting sideways. So what I can say is whichever way this thing breaks from here you'll probably get your next trade. Until then, it's all conjecture. I mean, if you know if you're going to sit there and a lot of these macro guys like to give consumption statistics and this and that about the economy and wage growth. So be it. I mean, I look at this in terms of Starbucks is stuck in a neutral range. I don't see a trade yet. If it breaks down, let's say below 75 again, 73, maybe you could take a shot on the short side. But that, interestingly, is to what you said, Bob, to circle back to what you said, coffee or Joe is basically still in this long consolidation. It had about an 80% run or something to that affected coffee futures in the first quarter of this year, and then it's just kind of been in this very long consolidation. Maybe this is some kind of left shoulder, head, right shoulder, inverse head and shoulders, continuation pattern before it goes higher. It still needs a lot of strength. So coffee's kind of neutral here, and so is Starbucks for now in the short term. Longer term, I still think coffee has the potential to go much higher, and I do think there's the potential for Starbucks to kind of come in. It's had a brilliant multi-year run, but that's what I'm looking for. We'll see again which way kind of the market breaks.
Fair enough. Are there any other items in particular that you wanted to cover?
Yeah, I was just for something more actionable. Corn. Okay. Just notice some of these soft commodities of late. Corn. Here's the corn fund fading off. It seems like corn gets a daily fade off the highs, but if you still, this could be a bottoming pattern here with corn, and then wheat has been pretty impressive too. First time, I noted yesterday in a chart, in a blog, in a chart, first time wheat has found support on the 50-day moving average, which is simply this darker blue line on my chart, since April. So corn and wheat, I think, are two ones to watch. Along the whole agriculture theme, left shoulder, head, right shoulder, and incidentally, if you traded back in 2007, 2008, the ag plays are classic late-stage bull market movers. So that is usually one of the last rotations you see in the bull market into the ag plays, into some of these materials. And again, one more thing, you take a look at GDX, the gold miners. Again, they're all over the place. They're going to be very volatile. This is huge territory on a monthly chart, back to the 2008 crash lows. So,
excellent. Well, I mean, I don't want to keep you too long. I'd love to have you back anytime you like, and I'm sure that for people that don't follow you on Twitter, it is CheesN, the letter N, wine. Great end of day market analysis, about 10 minutes long. Time and money well spent, in my view.
Thank you, Bob. You can find me over at marketchess.com. Marketchess.com.
Marketchess.com. Well, thank you so much for joining us. Please understand that you are always welcome, and thank you for joining us, folks. Take care.
My